Hey folks, that's Dave Burrows. It's Tuesday afternoon, time for a Barometer Readings webcast. I appreciate everybody jumping on. I think everybody is thinking your way through the market over the last couple of 3, 4 weeks. Obviously, a spanner in the works with what's happening in the Gulf and all of the hostilities. In some ways, we're all being yanked back and forth in the very short run by news items. Highlighted yesterday by comments coming out around 7:30 in the morning about a potential solution to the hostilities. Of course, an hour later, Iran is saying that there were no resolutions to the hostilities and that there'd been no conversations. And I think people are frustrated with the volatility in the market. And when we think about volatility, it's the reality that we're all living with day to day. I think it really is important to take the lens back, take a bigger picture view, understand how the news is interacting with the setup in the market coming in. Because at the end of the day, the market tends to behave or absorb news based on the stance in the market coming into the situation. So when the market's having a tough time, all news is bad news. And when the market is in a nice bull run, it can absorb a lot of bad news and just keep right on going. So we have to remember that the news is only one input, and there's 1,000 moving parts in the market. So to take the lens back and see the big structural themes that are dominating and have been dominating, to always ask the question, has something changed? I think is really, really important. So what I want to do is always is go sort of from the top. And as we've discussed, the U.S. stock market's been in a nice bull run since 2013. And of course, along the way, there's been lots of interruptions. But we've generally stayed above a rising 200-week moving average, which from here is a long way away. And I don't think any of us want to sit through this kind of a correction when you get stretched away from the moving averages. Corrections can be painful. So there's lots of ways to manage money. One approach is to say, well, over the long term, you can see the market works its way higher. And that's true. But, at some point, a secular bull market runs out of gas. And then you go through a secular bear market. And certainly nobody wants to live through one of those because these are 50 percenters. And it takes a long time to get the money back. So, as you know, Barometer takes a pretty tactical approach to things. I think every day we have to factor new information, look at the way the market's absorbing the news, look at how assets are interacting with one another to say, has the situation changed? And in an iterative way, we have to manage the balances of the portfolios based on the backdrop of the market that we have, not the one we want. So look, our job is to do three things. First of all, to find market leadership, the assets that are set up to benefit from a structural tailwind, where not only earnings are growing, but where the multiples investors are prepared to pay of those earnings is expanding, meaning that they are becoming more optimistic over time. That's the revaluation of an asset class. We have to watch for change, new leadership to emerge or old leadership to give up the ghost so that we know what type of adjustments we need to make in portfolios before it's obvious. And third, in the absence of leadership, having a willingness to sit on our hands and let the market show its colors. We don't have to be fully invested all the time. Now, if we were running a business at 5,000 clients and $50 billion in assets, well, maybe that's when you have to say, well, we're just a strategic investor. We build a mix and we stay with it over the long term. And I understand that's why, a lot of cases, bank firms, espouse that strategy. But we have like 180 families and not $50 billion. We run about $1.25 billion. And we can be tactical. So our strategy is a tactical one. We think that our clients are hiring us to be invested and take advantage of strong markets. But when risks get elevated, our job is to maybe play a little bit of defense, be a little bit more cautious, live to fight another day, not put clients in a position where they have to phone us to say, hey, should I take some money out of the market? So, look, let's take a look at the situation. In the short run, US stocks are under pressure. We talked over the last number of months about this process that the S&P was in a very tight range, but that the momentum was failing. This is a momentum indicator in the bottom screen, MACD. And you can see on the point and figure chart, we made a series of higher highs, December, January, pulling back and holding in each case. But, in February, unable to make a new high and made a lower low. Pulled back, rallied, and made another lower low. And have rallied as of yesterday, but unable to take out previous highs. And you can see that now we're trading below the 200-day moving average. So S&P at the low point down about 7.7%. Positives. The 200-day moving average is still moving higher. So when you dip below the 200-day moving average and it's still moving higher, there is a possibility it bounces right back above. The thing we don't really want to see is the moving averages roll over, but we've already seen the 50-day rollover, the 40-day rollover, the 21-day rollover. So the shorter term moving average has gone from pretty persistently higher to lower. So the nature and the character of the market has changed. Now, that's the S&P 500. And you can see that happened in the sell-off in the spring. The moving averages rolled over, and then we went through a decline. If we move to the NASDAQ picture looked like this last week. So the moving averages, the shorter term moving averages had rolled over. Market was trading below them. It had failed this first range and was in a lower range, but above the 200-day. If we look at it today, we're now below the 200-day moving average. And we failed down out of that range. So the NASDAQ 100 is down 9.25% since the high it made at the end of October. And so you can see why it is that we were reducing our exposure to technology, because of course NASDAQ 100 is the home of the largest tech stocks. I don't want to live through a 25% correction like it saw in April of this year. So below the 200-day moving average, below all the other moving averages, not great. Now let's look at the most important stocks in the NASDAQ 100. That's the Mag 7, the 7 big technology stocks. And similarly, they have been waning. So one of the things you always watch for is when stocks have been leadership in the market for an extended period of time and they're owned by almost everybody, not just in the US, but really internationally, because the US was the market over the last 15 years. To see the leading stocks roll over is something you have to pay attention to. Of course, the Mag 7 make up a big part of the NASDAQ 100. They make a big part of the S&P 500, and the Mag 7 is now down 16.4%. So this is not a great look. And to be honest, it makes me feel good about the fact that we are about 6% exposed to technology. Let's move on to the equally weighted S&P. Equally weighted S&P actually looks better than these other indices we're looking at because it takes out the impact of the very largest stocks and it equally weights all 500. Now, this is trading above the 200-day moving average. It's holding there so far. It's down 7.7%. But we watch that line. If we look at the TSX, it's a different picture. The TSX, S&P TSX composite has pulled back. It's pulled back a portion of its gain from the month of February, or its gain in January or December or November, October. So this is clearly in an uptrend. And it's behaving really well. It's interesting that in this sell-off, the relationship that started a year ago, where the TSX started to outperform the US stock market, continues to outperform the US stock market. So when you get a shift like this, like TSX outperforming from 2002 through 2008, and then underperforming for a long period of time, it tends to go on for a while. So we've said that, okay, look, when the S&P sells off, it impacts a lot of markets, and we're all impacted in different ways. The question is, does it change the big picture? And now for the last 14 months, we've been building exposure in Canada, reducing exposure in the US, and of course, we've been increasing exposure internationally. But this fundamental regime change, looks as though it's sort of here to stay. It's very resilient. Now let's look outside North America. The developed world, all index ex-US, certainly has pulled back in the month of March, basically pulled back to the 200-day moving average, sitting above. MSCI Eurozone ETF, EZU. This takes into account not only the local market, but the currency, because of course the currency pulled back a little bit over the last couple of weeks. It's pulled back. But something I want to highlight, when you come out of a bear market that's gone on for, 17 years, and you make new highs, you get an initial push higher, and you may get a check back to the point where it broke out from. And that's the opportunity for the people that didn't get engaged in the first place, that maybe are a little bit late, because once the long-term bull market starts, it goes on for a while. And you can see that on this relative return chart, the Eurostoxx 50 versus the equally weighted S&P went through this bottoming process over a 4-year period and broken out. Okay, so it's pulled back where it broke out from. So we think that nothing's changed there. On Japan, after a 33-year bear market, it's had a great 7 or 8, 9 months. And of course, it's been rallying for a while, but just having taken out the highs. So we've had a pullback over the course of a month. Does nothing to change the picture. If you look at the last structural bull market that went on from the late 1960s to 1990, there were lots of 1 and 2 month corrections in the trend. If we look at Taiwan, Taiwan's pulled back part of the gains from February, still holding above the most recent high. Korea is a similar picture. Shanghai pulling back like the EZU, sitting basically on the moving average. We'll see where we finish the month. That's what will matter. Mexico, same thing, sitting above the moving average, having just broken out. So what I'm seeing is that these international markets that only just started new bull markets certainly are impacted by conflict like everybody else, some of them more than others. Asia, some of the markets more impacted by the rise in energy prices. But these bull markets started, in the last year or two, and they should go on for a decade. So when you get a pullback like this, I think it creates the opportunity for new entrants. Latin America is the same picture, broke out, pulled back to the moving average. So if we look at the MSCI All World Index relative to the equally weighted S&P over a 5-year transition to relative outperformance for international stocks, we broke out here from this previous high, and we just pulled back into the breakout. So not too concerned about that. Obviously, we worry about risk. We look at the emerging markets, just broke out, pulled back to the breakout point. Emerging markets versus the equally weighted S&P. Broke out, pulled back, rallied, pulled back, sitting right on top of the moving averages. So if the question is, should we be reevaluating our movement into international stocks, the answer, I would say, clearly is no. This is something that we want to be in, and I think that the differential in valuations gives us a safety cushion. Emerging markets, developed market, frontier markets considerably cheaper than the US. US market could underperform, international markets could outperform, but this gap is likely to close like it has done in each case in the past. And that's why emerging markets, once they start to outperform, tend to outperform for a long time. So now look, we don't have to be everywhere. We have to use our processes to make our decisions. We use this combination of our top-down tools to try to identify where is money getting put to work, and those areas we consider to be market leadership. We then do a bunch of bottom-up work to try to identify securities that are good, getting better, where we're seeing improving fundamentals and that are technically sound. And that's the question right now, which companies are technically sound as well as fundamentally improving, and where there are companies that are good, getting better, both technically and fundamentally in parts of the market that are seeing net inflows of capital. That's where our portfolio should live. So look, there's a time to play offense and there's a time to play defense. And for us, the time to play offense is when you've been through a decline and you start to see securities turn higher while the market is weak. That tells you that they're technically and fundamentally sound and that investors have conviction. They're prepared to put money to work even though the market has been sloppy. Now, we don't like to buy a falling market, and we won't. But we want to see which securities are the ones that start to buck the trend early and are the early outperformers. And when breadth starts to expand like this, that's when we want to start looking at putting money to work. So when you're going through a decline, you're building your farm team. And when you've got the wind at your back, you want to be invested. And so long as breadth is expanding at the market level or geographically or in a specific sector or theme, that's a focus area for us. At some point, though, in markets, breadth starts to narrow. And so, the example I'd use here is over the last 12 months, we've talked pretty consistently about the fact that growth stocks in general, US growth stocks in particular, and in many cases, technology has been narrowing, fewer and fewer stocks holding their long-term uptrends. And when breadth narrows, eventually, when things start to get weaker, they get to the leaders. And now we see what's happening in that Mag 7 cohort. So you've had narrowing breadth in technology, and now getting to the leaders, that's a period where you see higher risk. So in our strategy, being tactical, there's a couple of things. When breadth starts to narrow at the market level or in a sector or a theme, we stop putting any new positions on. We raise 7 or 10% cash to start with. We tighten up the stop losses on existing positions. So to the extent we start getting stopped out, the money goes to the sidelines and stays there. And we work away at building the list of companies we'd like to own if conditions improve. So over the last few weeks, we've seen the breadth models that we follow narrowing. The percent of stocks in uptrends in Canada, the US, globally have been weakening. The percent of stocks trading above the 50-day moving average, and percent of stocks with momentum, and the percent of stocks making new highs versus new lows, the percent of stocks trading above their 30-week or 150-day moving average, moving to the left. And that's been continuing as we've gone. So as we sit today, we're now getting to a point where the short-term indicators are getting a little more washed out. Percent of stocks with the 50-day, percent of stocks with positive momentum getting to the far left. But we're still really not at washout levels. When we look at breadth within the geographic regions, we know that on the distribution curve, countries have been moving to the left, meaning fewer and fewer stocks in uptrends across these markets. So equities we are cautious on, and we'll talk about positioning in a few minutes. On the fixed income front, we've had a view that rates bottomed in 2020 and long-term bond yields have been working their way higher since then. Last week, we talked about the fact that we've been in this very tight range over the last year, while people have expected that long-term rates would start coming down because short-term rates are coming down. Now, when the Fed cut rates 18 months ago, for the first time in 40 years, long-term bond yields did not go down with them. That's the market setting the bond yields. Now, you can see if you look closely on this monthly bar here at the end, we are now above this most recent line. Let's look at the shorter term picture. So I think this is bothering the market. When long-term interest rates go up, that is financial tightening of financial conditions. It means that if you own long-term growth stocks and the long-term bond yield goes higher, you have to use a higher discount rate on future earnings to bring them back to a present value. And that makes it harder when long-term rates are going up for people to pay a high multiple for stocks. And we're seeing that in the NASDAQ. On the US dollar bounced coming into the conflict, but has been pulling back now over the last 2 months. So I think people thought the playbook is US dollar takes off when there's conflict. And interestingly, we're really not seeing that. So my premise has been once we broke down technically, we would retest underneath this level, but ultimately US dollar moves lower. And I still think that that's the case. So, weaker US dollar and weaker US stocks gives international investors less incentive to be so focused in the US. If they're concerned about geopolitics, they may or may not be as interested in having as much exposure in US stocks. We think that that might be influencing markets as well. Moving on to commodities. Commodities keep going higher. So as soon as the global tightening cycle ended, they started marching higher again, first led by gold, then by copper, and of course by energy over the last couple of months. So crude clearly is broken out of its range, and I think that's very early stage. On gold, gold has been in a bull market since 2023, but we've talked about the fact that it got very stretched above the long-term moving average as of January, 121% above, and that it was likely to correct. We talked about the fact that we pulled back, we made a lower high, this was last week. And this week, gold moved lower and it came down and tagged this moving average, a pullback of 26% off the highs. When we look at the shorter term picture, you can see that it happened over about 4 weeks. We tagged the 40-week moving average, almost made it to the 50-week moving average, which is the little over 200-day moving average. And that's about the correction that we expected. So we'll see. On silver, you had our first pullback and a bounce of 50% of the decline, but we said we think it takes longer. This week, we got the second shoe to drop again, came down to the 40-week moving average. So the question is, is this where it holds? We don't know. Generally, when you get a correction out of a parabolic move higher, it takes some time. But my guess is we've probably seen the lion's share of the correction. Silver corrected by 50%. And when we talked about that, we did get a little bit of hate mail. How could silver pull back when there's a physical shortage? Well, the net of it is that's 50% pullback. That's about sort of what we expected. And the stocks pulled back about 35%. If we look at the long-term picture again, though, does that change things? It doesn't. We went through a regime change where gold underperformed stocks from 2011 until 2022. We went through a bottoming process. We had a first move higher. We pulled back to the moving average. We had a second move higher and pulled back to the moving average. And we've rallied off that over the last couple of days. So my guess is this is a reset. And the truth is the question, what is the best asset? Commodities relative to the equally weighted S&P, this is a pretty clear picture. We went through this consolidation after the first move, and we've blasted through this, certainly with the help of oil. Copper broke out of the bear market it was in from 2011. It's pulled back and tagged the moving average. We'll see whether we bottom in and around here. We'll let the market do a little bit of work. Commodities relative to bonds, very clear picture. The market's telling us the risk is inflation, not disinflation. If it was disinflation, bonds would be leading. Commodities are the thing that's leading. Commodities relative to equal weight S&P, very clear story. Now, the reason that this is important is that the moves in commodities can be fairly significant. The moves in gold go on for like a decade. When people start to build their positions, it takes a very long time. So, look at the way the ship is tilted. This is the total value of U.S. equities. This is privately owned treasuries, outside of institutions. This is the total value of the open interest in the oil market and the open interest in the gold market. So for money to come from these buckets into these two buckets can go on for a long time and can have a significant impact on price. It's like a bunch of people trying to squeeze through a very small door. When we do our relative return chart, This is comparing the asset classes from the weakest to the strongest. Now commodities are the strongest weight, international equities second, domestic equities, meaning US third, cash, currencies, and fixed income. This is why we've been underweight fixed income. When commodity cycles start, they go on for a long time. Okay, let's talk sectors just for a minute. We're going to start with the one of the hour, and that's energy. This is the Canadian Energy ETF XEG. These are monthly bars. So this takes us out of the range that had been in since 2014, month by month. We've been working. Sorry, these are weekly bars. So this is like the last 2 months since we broke out. This broke out in the beginning of January, a long time before there was any expectation of hostilities with Iran. Again, I always say the news is important, but it's against what backdrop? Large cap energy stocks were breaking out before this took place. This is the global ETF for global energy producers, IXC. This is the last 3 months, January, February, March, and clearly we've broken out here from the highs from 2008. Let's look at the XLE. Made a high in 2008, made another high in 2014 with oil at $160 a barrel. Look at boom, boom, boom. That's the beginning of a new bull market. So I know we've come a long way in a short period of time. I know that everybody's hanging on Trump's every word. I don't think this whole setup is dependent on whether the US president solves a problem with Iran or not. If he does, could oil pull back? Sure. But the structural setup is we're in the early stages of a bull market in energy, and it was led by copper and led by gold before that. We're in a commodity bull market. Long life Canadian energy assets have been leading. These companies have, 50 years of reserve life. Suncor marching its way higher through a tough tape. Canadian Natural Resources marching its way through a tough tape. Imperial Oil, these are cash flow generating machines. They're going to be great dividend growers. They are among the largest positions in the firm. Tamarack Valley, we also have Headwaters. So no change here. This is really important. Part of the reason why the Canadian market is behaving the way that it is. Now, this started against the backdrop where investors were about as underweight energy as they have been at any time. Energy assets as a percent of ETF assets under management are less than 0.5%. So that can go on for a while. Let's move on. Industrials have been very strong. They certainly have pulled back over the last 3 weeks. Point and figure chart is very constructive, higher highs and higher lows. Nothing to change here. This is the 40-week moving average, which is the 200-day moving average in green. We're trading well above it. The equally weighted industrials versus the equally weighted S&P has only just in the last 2 months broken out above the relative highs from 2008. So if we're comparing how industrials are doing relative to the rest of the market, while they have been outperforming since the lows in 2022, if we're looking at it through my lens, which is what does it mean when you make a new relative or absolute high after many years of underperformance, it means you're still relatively early in a new bull market. So this has been a big weight for us over the last 2 years, and it continues to be. Companies that are in and around the energy equipment market, like BWX Technologies, small nuclear reactors, or GE Vernova making gas turbines to create auxiliary power for natural gas power plants or for data centers at this point. Caterpillar equipment, selling equipment into the mining industry, certainly pulled back through the course of the last couple of weeks, but look at relative strength versus the rest of the market, trading better than 95% of companies in the S&P. So industrials continuing to march along, and certainly defense going along with it. Financials. This is the XLF, down 13.2% over the last 3 months. So it has been pulling back, which is part of the reason we have a little bit less exposure. The BMO equally weighted Canadian Bank Index is down 9%, still trading well above the 200-day moving average. That's a pretty normal pullback. But there's areas of financials that are weak. Digital payments and fintech. This is MasterCard, Visa, PayPal, really underperforming now for months and months and months. Insurance, really underperforming for months and months. The private equity companies. These are the BDC companies that issue private credit, and some of the private equity companies like Apollo, BlackRock, Carlyle, and so on. They're really under pressure, and we almost by the day are hearing more and more private equity funds and private credit funds being gated, meaning investors can't get their money out. I've always said that liquidity is underrated. Having the ability to make the decision you want to take some money off the table, we think should come at a premium. And interestingly, a lot of private investments have been trading at a premium, even though they're illiquid. And so we really like to stay with public assets. US broker dealers are below the 200-day moving average, and relative strength has been waning, which is why we have lower weight. They're now down 14% off the highs. Moving back to materials, the materials producers are actually performing pretty well. They've certainly pulled back. We pulled back to the moving average. We'll see whether things hold in here. The XME relative to the SPY. This is the metals and miners ETF relative to the S&P 500 on a shorter term basis. Again, you saw this bottoming process. You broke out. This is hard assets versus financial assets. So the big cycle change since 2020 when rates bottomed was that inflationary assets started to outperform. And things that protect you against inflation. Materials producers put their price up tomorrow if demand is up today. And hard assets are clearly outperforming. Now, the fact that they've pulled back a little over the course of the last month, not a big deal. This is what they do. And that's why they're called cyclicals. And they do pull back more than other sectors. And that's why we have to manage them. But, in the case of the gold producers had just about a 35% pullback off the highs. Pulled right back to the 40-week moving average. Now, this is where they should hold. So in our macro portfolio, we actually just added some precious metals weight back in our macro portfolio after selling them in January. So small positioning, we'll see what happens next. Copper's the same, pulled right back to the moving averages. If you look at the long-term picture, and copper relative to the S&P 500 on a monthly chart, again, just pulled back to the breakout point. So painful in percentage point terms, and we don't sit through that in our equity portfolio. We stepped away from some of these positions. I would expect that we'll be buying them back at some point. So the last thing I want to talk about is tech. Tech continues to wane. This is the software sector has been weak for quite some time, under pressure for concerns around, what AI might do to the value of packaged software. Social media has been under pressure around the world. And now Mag 7 is under pressure. So we are getting to the leaders. We're trading below the 200-day. We're very cautious. The one group that's continued to perform well is semiconductors. The semiconductors index is up, has traded better than 90% of securities in the S&P 500. As you know, the only position we have here, we have two. One is NVIDIA. And to be honest, on a relative basis, it's basically been treading water. We're trading right at the bottom of the range. We did let half of our position go last week. I am concerned that we're going to break below the 200. Relative strength has been about flat. Lam Research, on the other hand, which makes equipment that builds the semiconductors, has continued to be very strong. So other sectors, consumer discretionary, as we've said for quite some time, relative strength is weak, nothing really to do here. Get into weak market, and it performs weakly. U.S. consumer expectations have been weakening. So as I mentioned 2 weeks ago and again last week, if you look at the times when energy and staples outperformed while financial and tech were weak, the forward-looking 6 months doesn't tend to be overly positive. We talked about the fact that in an election year, between February and October, you can have some sloppiness. And we are having some sloppiness. We talked about why it is that we don't chase into the defensive assets when they do well going into a problem, because once you're in a problem, they tend to sell off like everything else. And this is the low volatility cohort of defensive securities in the US. So what does it mean? In January, the average sector had 48% of stocks in uptrends. If you took all the 41 sectors and put them on a distribution curve, it was a pretty normal distribution curve. To the far right were the strongest sectors where the highest percentage of stocks were in uptrends, and they included precious metals and banks and semiconductors and insurance companies and steel and metals, cyclicals. On the 13th of February, it had moved down to 48%. We had some sectors moving further to the left. By the 16th of March, we were stacked up more on the left, with the average sector only 37% of stocks in uptrends. And as of this week, the average sector has 35% of stocks in uptrends. Now, there's a lot of sectors stacked up down here on the left. They're the weakest ones. On the right, there's still some groups that are behaving pretty well. Some of the big banks are still performing well. Oil's obviously performing well. Oil service performing well. I mentioned semiconductors is holding up. Transports, this is industrials. But it's a smaller group. So the question is, how long does this go on for? And the answer is, the market's going to tell us. We run our breadth models every single day. I know when sectors start to show expansion. We can see when geographic regions start to change. And our job is to have identified securities and sectors that are behaving better than the rest through the decline, so that when it's time to put money to work, we can step in and we've got stuff to do. One day where the president says there might be a resolution is not enough to do that. From a technical perspective, we need to see a big up day on big volume. And then what we want to see is from day 4 to day 7 after that, another big day on volume. And it's not so important to be 100% invested on those days. It's more important to play defense so long as things are sloppy. So what's behaving better? Value in general is behaving better. This is the value ETF VLUE. You can see relative strength has continued to rise versus the rest of the market. And that's sort of reflected in the portfolios. So as we sit today, across the firm, we have about 22.6% in cash, plus about 7.5% in T-bills. That makes 30%. So about 30% cash. In our equity strategy, we have about a 10% short position in the S&P 500, which means that we're about 40% cash in that strategy. In our income portfolio, yes, we're 30% cash, but we have 10% of the portfolio in our global music royalties fund, which is just an income vehicle that is not economically sensitive or not market related. So that's like 40% cash. In our macro strategy, we're actually net short the market. So we're long some materials, we're long some international stocks, we're short US stocks, and we're short the US bond market. Across the firm, we're about 60% Canada, but that's because that's where we're holding our cash. We're about 18% US and about 20% international. And we haven't gone down to hide in the defensive assets because they don't tend to do well if long-term interest rates are rising. These do well in disinflationary periods, so where there's no use in putting the money to work if we can sit in cash. So I think we have a lot of optionality. The portfolios are really defensive. If it gets sloppier, we'll get more defensive. If things start to change for the better, we've got things that we can do that are hanging in better than the market that we would look to first. But there's things that have to happen before that. Now, in the underlying economy, we're watching credit spreads. They're fairly narrow. There are some real concerns in private credit, and a lot of money has chased into the private credit market. We have a 0% weight. From a volatility perspective, volatility is elevated, and that's why we want to be a little more defensive. These are the green ranges are where volatility tends to stay in the strongest of markets. Now, lots of times it spikes out and comes right back in. Spikes out and comes right back in. So we'll see. For now, we're in a long-term bull market in US stocks. We've seen some relatively early stage weakness. so we have less exposure. If things get more difficult, as is the case, we'll just continue to get more defensive, and I think that we're pretty good at playing defense in a tough market. So the risk is the market turns around, takes off, we get left behind for a couple of days with some cash. That's okay. If we get into a new leg higher in the market, it'll go on for months and we'll have lots of opportunity to make money. We've had a great start to the year, and we want to protect those gains. So with that, if there's any questions, let's just take a look. Stan is asking the question about Agnico Eagle. We did come out of Agnico, I guess the halfway through, 2/3 of the way through last week. Not happy about that. I think that Agnico is the best precious metals producer. My guess is at some point we'll be back in it. It has come down a fair ways since we got stopped out. It did come down to the moving average and is held there. So we'll see. My guess is at some point we'll own it again. But as I say, we can have a fundamental view on a company. We can have a long-term view on an asset class. In the short run, we have to tactically manage the portfolios so that we don't wind up letting a little mistake turning into a big one. We had a great pass on Agnico. It's the one position that we held on to when we let our positions go in January in fixed income. And it certainly came down, but we captured a very big gain along the way. Patrick is asking, given the damage to Middle East LNG facilities, are we positive on North American natural gas? We do own Tourmaline, and that gas in general, long term, looks like a positive theme. The tricky part is getting too vested in natural gas, at the end of March. As they say, sell in May and go away. So we'll see. My guess is natural gas market's going to be an interesting one. There's going to be a lot of developments. The U.S. has done a great job in building a lot of LNG infrastructure. And if I look at the way that the MLPs, the pipelines, are behaving in the U.S., they're behaving really well. We own Enbridge in Canada, and Enbridge as a pipe company has done really, really well, and really disciplined company. So I think there's going to be opportunities both in midstream assets and in the natural gas companies themselves, but we do lean more towards oil. Due to the dependency on Middle East oil, do we believe Japan they can have a bigger impact on Japan? You would think so. But first of all, Japanese stocks are very inexpensive. Second, there's a lot of machinery companies. So it's less about the Japanese domestic economy and more about the exporters that we've been focused on. And in fact, Japan's hanging in pretty well. So, we'll play the market that we have, not the one that we think we have. And frankly, breadth in Japan, it's the only market that has positive breadth currently. So we're there, and we'll use our stops. But I think in general, we still have solid Japanese exposure in our macro portfolio. We still have emerging markets exposure in our macro portfolio, even though we are overall net short. We're short U.S. stocks and long international stocks. Let's see what else we got here. Greg is asking about our stop loss strategy. So here's the truth. When we put on a portfolio over the course of a year, let's say we put on 20 positions, we're trying to buy things that are good, getting better. So things that are good, getting better should have improving earnings, but also as people recognize that something is changing for the better, they begin to pay a higher and higher multiple of those earnings. So rising earnings plus an expanding multiple is how you make money. That's what happens in a bull market. Now, out of the 20 positions that we put on, realistically, 2 or 3 work out way better than we ever expected. They're just getting better faster than we thought, like a Howmet Aerospace over the last few years. 7 or 8 will be pretty good, and a bunch aren't going to work. So the way you make money is you stay in the positions that work as long as they continue to work. I've mentioned before, like we owned years ago Fairfax from 16 to $600, and of course we had another giant pass in it 3 years ago. You don't see that coming. So by using a stop loss, the first and most important thing about stop losses is it lets you stay in your winning positions as long as they work. So the question is, the big oil companies have been great. It could go on for years. We could wind up there for a long time. So when we put on a position, let's say we paid $20 a share and $18 is our line in the sand. The line in the sand is determined by the point where there will be a technical change in the nature of the stock. So we use technical analysis. I use point and figure charts. Point and figure charts, the X's and O's charts are very good at recognizing where it goes from being in higher highs and higher lows. That's constructive. To lower lows and lower highs. That's not constructive. And so we identify those change points and we use those as our stop loss, where it goes from being constructive to not constructive. Now, as a position works out, as we hope or expect, we'll constantly be ratcheting the stop loss up underneath. So that does two things. It means that we can stay in the positions that work as long as they work. But on the ones that don't work, they hit our stop and they come out and we wind up with cash again. Now, from a technical standpoint, we add up the differential between where our stop loss is and the current price on a weighted average basis across the whole portfolio to know what is our total risk if every position gets stopped out. And that has to be something that we can live with. So we're constantly raising the stops. We will use them, whether we think the long-term view is constructive or not, because we can be wrong. And that just makes sure that we get stopped out. The first time I ever went to a casino, I've been to a casino 3 times. I hate to gamble. I went to the table with $400 and I left $1,200 in the room. I knew that if I lost the $400, I had to walk all the way through the casino, go up the elevator, find my room, get money, and decide if I wanted to go back down. The stop losses are a great circuit breaker. It's very easy to rationalize holding on to a losing position. So the stops let us stay in the positions that work as long as they work, and the ones that don't work, they come out quickly and quietly, and we step aside and wait for a better opportunity. We only need 20 to 30 positions in a portfolio, and we're not managing $50 billion. We can step aside. Diana on the trade desk can have us off a position in about 10 seconds. And we do that at one price for everybody all at once in one block trade. That's what we get paid for, managing positions. Sebastian said, can you touch a little on private credit concerns? Yeah. So private credit has become a massive asset class. These are funds that have raised money from investors and lent them to borrowers that might not otherwise want to borrow from the bank. So a great example is what's happening with a lot of the lenders who have been lending to the software industry. Right? A software company doesn't have hard assets that the bank can take and auction off if they don't pay. Right? It's just IP. And so the private credit funds got very interested in lending money to software companies that were taking the money to go out and market to gain new subscribers to their software. And the story was, well, by marketing effectively, they can keep adding subscribers, which is monthly revenue, which then can easily cover the cost of the debt. Unless the software subscriptions stop selling, or unless the business gets disrupted and the subscribers leave. So what happened is, I think very big institutions got involved and a lot of money was raised, and they've done a lot of private debt deals with private companies. And as is always the case, eventually the big company said, well, let's sell this to private investors as well. And private investors want in on this. And I know, like 3-4 years ago, we started getting calls every week saying, would you like to take a look at our private credit fund? Wouldn't your investors like to get in this? I think a lot of advisors like them because, frankly, they don't get priced every day. It's a static price. So it looks very stable in the portfolio. until you say, I'd like to have my money back. And they say, well, we don't have enough liquidity for that. And it's private, so we can't just sell it. And I think one of the big issues now is that with long-term interest rates going up, the value of the future stream of cash flows has to trade at a lower multiple, and the prices that they have these assets marked at are just wrong. If they were priced correctly, it would be easy for them to raise money to give back their investors. But now they're gating investors. So virtually every private equity company that's in the private credit business is starting to see redemptions. And the question is, who will be the buyer of these assets? So I do think it's something that's going to be a bigger deal. And I think we want to be really careful around that stuff. And it can have a negative impact. And they say, well, it doesn't sit on the bank's balance sheets because it's private funds. But the funds raised money, and then they turned around to the banks and said, we've raised this much money. Why don't you lend us some money? And between this, we can create some leverage. And so, in fact, I think the banks do have a lot of exposure to this. But that's a simple explanation. MDA was down 10%. Today's a good time to buy. So look, from our perspective, we got a lot of great investments, and the ones that are hanging on nicely, we're very happy with. Things do pull back in a market pullback, as long as they don't technically break and MDA is not broken, we're fine. But we're not buying anything. We're going to sit on our hands for now. And S&P is off 7.5%. Could it be off 20%? Sure, it could. And if that's the case, I'm going to be really happy that we have this cash. So no, we're not buying anything right now. How about India? Ron is asking. India has been an underperformer now for about 18 months. It continues to underperform. It's about the worst major international market. So I would stand clear for now. What is the best ETF for access to emerging markets on the TSX? I have to tell you, I don't look so much at the ones on the TSX, but you could look at, I think technically, but the best setup is in PIE, and that's trades in New York or in the US. And that is made up of some stronger relative strength emerging market stocks. ESGE is also a pretty good one. But again, breadth in international markets has been attracting, so I'm going to wait and kind of see what happens there to see if we add anything more. They're behaving quite well now, but let's wait and see. Eve is asking why Canadian banks are so expensive with high multiples, low dividends, and the Canadian household in such bad shape. And Eve goes on to add a lot of things. So the concerns on the Canadian banks would be that the Canadian real estate market is having a lot of difficulty. And so that means the Canadian consumer might have some difficulty. There's a lot of private debt in Canada. The level of private debt in Canada exceeds the amount of private debt that there was in the US when the US went into its housing crisis in 2008. It exceeds the amount of private debt that the Japanese had in 1990 before they went into 30 years of weak performance and disinflation. I'll be honest, I'm quite concerned about the Canadian domestic economy for consumers. And that's one of the reasons we have no consumer exposure. The Canadian banks have been pretty good at building business outside of the mortgage business. Some banks have more mortgage exposure than others. In a lot of cases, they have sold their mortgage exposure, to the Canadian government and guaranteed mortgages. We're watching the Canadian banks very closely. They've been really strong performers. We did step away from Royal 10 days ago, so our exposure is less. But that's certainly something to watch in the Canadian economy. The real estate market is facing a lot of resets on mortgages this year and next year. And there's a major mismatch of a small number of buyers and a lot of sellers, which means that prices are probably going to have to come down, sadly. Patrick is asking about the Mideast conflict and where we see WTI's new price floor. Great question. I think that energy prices are going up for a lot of reasons. I think it's not going to be easy for Trump to put this genie back in the bottle. And my guess is, we're going to see energy prices higher before we see them lower. So could they go to $150? They absolutely could. And the longer the Straits of Hormuz are closed or effectively closed, the bigger the deficit that's going to be created. And the differential, the amount that we're missing every day is dramatic. 18 million barrels a day were coming through the Straits of Hormuz. About 5 million barrels of that is going through the East-West pipeline through Saudi to the Red Sea. So that's a little piece of it. So that leaves 13 million deficit. The OECD has released about 440 million barrels of oil, but it can only come out at 2 million a day. Okay, so there's 7 million barrels trying to offset 18 million. And of course, other countries are trying to increase their production. So that's a huge delta. And it's having a really big impact on diesel fuel. It's having a big impact on jet fuel. There are airlines going to start cutting back their routes. And that's one of the reasons we actually quite like railways, because when energy costs are high and diesel prices are high, railways become very, very, very competitive. So from a big picture perspective, they would definitely be on our farm team. We do own CP. Nader's asking where we hold our cash. We use T-bills. We also use a money market fund. We don't tend to leave it sitting there in cash at the bank. Carolyn's asking what would be a good entry point to buy Alphabet, and do we like the growth potential over the next 5 years? Look, I think that Alphabet is a wonderful company. Let's just see if I can put up on the screen here chart. You know what? I'm not set up for it today. I'll have to. Well, I can do it this way. Let's do this. This. Okay, stick with me. So there's the Alphabet chart. As a technician, this is not a good look. It's trading above the 200-day moving average. Now trading below the shorter term moving averages. If I look at the relative performance, momentum has been waning. I can tell you that this has been a position for us, and we had a call late in the afternoon about our exit. And so because I was putting the deck together, I'm not sure whether Diana and James went on the Google or not. But when you put that in context with the Mag 7 ETF, which is looking very toppy and trading below the moving averages, and the backdrop isn't great. If the market weakens enough, it gets to the leaders. And so I would not be a buyer of Google currently. I would wait. Off-topic question, thoughts on financial advisors moving towards single multi-asset 60/40 international ETF for mutual funds, 60/40. So that's saying 60/40, meaning they move their clients to one mutual fund or ETF. Ooh, well, I don't love the idea of one mutual fund or ETF. I don't love the idea of having 60% of your money in equities and 40% in bonds, because bonds are not the offset currently to equities. When bonds are going down, stocks are going down. And that's why we're trying to use inflation assets instead of disinflation assets. Bonds do well in disinflation. They don't do well in inflation. From 1951 to 1966, interest rates went from 1.6% to 6.6%, and bonds gave a 0% rate of return against inflation. Housing gave a 0% return against inflation until 1981, because that's also an asset that doesn't do well when interest rates are going higher. stocks went up 15% a year, and in particular, commodities did really well. So we think that commodities are the hedge, and we think that companies that can raise price are the hedge, big cash flow generators. If you look at GCOW, that is an international portfolio of cash generating companies, and it's performing way better than the market. We own this in our macro portfolio. So cash generating companies that don't borrow money do well when long-term interest rates are going up because they hurt companies that have debt. Power is in the hands of the lender. Okay, we've answered a lot of questions. I think we got most of them. I appreciate everybody jumping on. If you got more questions, reach out to us. We've had a lot of calls recently. We're very happy to take them and answer them. I jump on and it's great for me to get to know some more folks. And so don't hesitate to reach out. Otherwise, we'll see you again next week. I hope you find this stuff useful. Everybody stay safe. Bye.